Okay, let's unpack this. Can Uniswap, often considered, a bedrock of decentralized finance, truly skyrocket to a valuation of $70? And if it does, what seismic shifts could that trigger across the entire crypto landscape? Not just for the token itself, but for the fundamental way we perceive and interact with digital assets.
It's a huge question, right? A really bold target.
Definitely. We're talking about Uniswap, the undisputed titan among decentralized exchanges, or DEX, an innovator that basically wrote the playbook for so much of what we see in DeFi today. Right now, its native token, UNI, is trading in that crucial range, sort of hovering around the $7 to $8 mark. Give or take, market's always moving.
Exactly. It's a live market.
Now imagine a leap from there to $70. That's not just hitting a new all-time high, it's nearly doubling its previous peak.
Yeah.
That kind of meteoric rise would absolutely send shockwaves through the industry. It would signal, I think, a profound shift in market confidence and maybe the maturation of decentralized finance itself.
Indeed. And our mission today, really, is to meticulously dissect the primary catalysts, the significant challenges, and the intricate market dynamics that could realistically propel UNI to this ambitious $70 price target. We're going to dive deep into the data, the economics, the narrative, try to give you a truly comprehensive, well-informed perspective. Our goal isn't just to tell you what could happen, but to help you understand why it matters, what it could signify for the broader DeFi ecosystem, and crucially, what it means for your own engagement with this rapidly evolving space.
So to begin, let's anchor ourselves in Uniswap's current reality. As we record this, UNI is fluctuating roughly around that $7 to $8 mark. It's essential to hold that number in your mind because a $70 target isn't just some optimistic projection, it's a monumental reevaluation.
Absolutely monumental.
And to truly grasp the scale of that ambition, we have to revisit its history. Its all-time high, or AT, previously stood at around $44. That was back in May 2021, peak bull run stuff.
Yeah, a moment of intense euphoria, like you said.
Yeah.
But also a ceiling, right? A ceiling that UNI hasn't really touched since.
Exactly.
And that historical context is absolutely critical for understanding the magnitude of our target here. A move to $70 wouldn't just shatter its previous ATHs, it would nearly double that peak value. To put this in stark financial terms, if UNI were to hit $70, we're talking about a projected market capitalization somewhere in the realm of $42 billion to $50 billion.
Wow. Okay.
Yeah. And this isn't just a big number in isolation. It would firmly place Uniswap among the absolute top-tier crypto projects by market cap. We're talking about it entering the same league as established giants like, say, Solana and Avalanche. It demonstrates a level of scale and perceived value that only a handful of decentralized protocols have ever achieved. It would be a definitive statement of maturity, resilience, and frankly, immense enduring value for the entire DeFi sector.
That's a great point. For comparison, you think about companies in traditional tech like Spotify, sometimes around a $30, $40 billion market cap. Or even Snap, Snapchat's parent company, often in a similar range.
Exactly. UNI reaching $70 would mean it's playing in those big leagues, not just within the crypto bubble, but, globally.
That comparison truly puts it into an incredible perspective. This isn't merely about a token's price. It's about its gravitational pull, its influence within the global digital economy. And when we discuss influence, Uniswap's dominance in DeFi is, quite frankly, unparalleled. It is, without question, the largest decentralized exchange by trading volume, and it has maintained that position for a significant period.
You're absolutely right. And what's truly fascinating here is that Uniswap's dominance isn't just a claim. It's robustly quantified by genuinely impressive statistics. We're talking about billions of dollars in weekly trades consistently flowing through Uniswap's various liquidity pools. Billions. Every week.
That's incredible volume.
It signifies not just incredible liquidity depth, but also speaks volumes about the platform's unwavering user engagement, the trust people place in it, and its robust infrastructure. And here's where the plot thickens a bit. Uniswap often surpasses even formidable centralized exchanges like Coinbase on specific days in terms of trading volume.
Okay, that's the real aha moment, isn't it? The idea that a decentralized protocol governed by its community, running on code, can actually outperform a huge publicly traded company like Coinbase on any given day.
It's not a minor achievement. It's a profound testament to the power, the efficiency, and the growing adoption of decentralized infrastructure. It's directly competing, and in many cases outcompeting, traditional regulated, centrally managed exchanges. It signals a real shift in user preference and highlights the inherent advantages of, a permissionless system.
It really underscores the raw power of its foundational role and that first mover advantage they had. Uniswap didn't just iterate. It truly pioneered the concept of automated market makers, AMMs, and introduced liquidity pools to the mainstream crypto audience. This wasn't just some incremental improvement. It was a fundamental reimagining of how decentralized trading could work. Made it significantly more accessible, more liquid, and more efficient for pretty much
It
everyone.
was an absolute paradigm shift.
Yeah.
Before AMMs, most early DXs, they relied on traditional order books, similar to what you see on Coinbase or Binance. But in a decentralized on-chain environment, these order books often suffered from severe limitations. Low liquidity was a big one, high gas fees for every single order placement or cancellation.
Oh, yeah, I remember those days. Painful.
Yeah, and just generally a poor user experience.
Yeah.
Imagine trying to place and cancel orders quickly when every action costs you gas and takes minutes to confirm. It just didn't work well. Uniswap's AM model, at its core, replaces that order book with simple math. Instead of matching buyers and sellers directly, you trade against a pool of assets, let's say ETH and USDC. The price is determined by the ratio of those assets in the pool, based on a simple formula, X times Y equals K, where X and Y are the amounts of the two tokens, and K is a constant.
Right, the constant product formula.
Exactly. So when you swap ETH for USDC, you add ETH to the pool, remove USDC, and that subtly shifts the ratio, and thus the price. Trading becomes instant, always available, regardless of whether there's a specific buyer or seller waiting on the other side. This totally democratized market making. It allowed anyone, literally anyone, to provide liquidity in exchange for earning trading fees. And that fundamentally solves the liquidity problem for decentralized trading, creating this entirely new financial primitive that, its current dominance is built on.
Okay, so with that incredibly strong and innovative foundation firmly in mind, let's shift our focus squarely to the future. What are the pivotal catalysts? Those powerful winds of change that could genuinely propel UNI from its current standing, around $7 to $8, all the way to that ambitious $70 mark. First up, and this is a topic that consistently sparks intense debate and, let's be honest, excitement within the community, is the potential implementation of the fee switch. For those listening who might not be intimately familiar, what exactly is this fee switch and how could activating it fundamentally unlock such significant token value for UNI holders?
Yeah, the fee switch, it's probably the most talked about potential catalyst. It's a governance-activated feature that's actually been hard-coded into Uniswap smart contracts since, well, basically the beginning. If the community, through a formal governance vote, decides to flip the switch, it would allow a portion of the trading fees generated on the protocol to be directed straight to UNI token holders.
Okay, so right now those fees go somewhere else.
Exactly. Currently, all trading fees, typically it was 0.3% per trade on the older V2 pools, or it's a variable percentage on the newer V3 pools, go entirely to the liquidity providers, the LPs, the individuals who supply the assets to the pools. The proposals around the fee switch, they've historically suggested capturing maybe 16th, perhaps up to 15th of these LP fees. So for example, on a pool with a 0.3% fee, maybe 0.05% or 0.06% of each trade's value would go to UNI holders instead of the LPs.
Okay, that seems like a small percentage, but given the volume Uniswap does.
Exactly. Given the billions traded weekly, even that small slice adds up to substantial revenue. And this seemingly small change would be absolutely transformative for UNI's economic model.
That's a profound shift then. So UNI would transition from being purely a governance token giving you a vote, basically to becoming a yield-bearing asset, letting you directly share in the protocol's success. How would that immediately impact demand for the token? And I guess, are there any downsides, any counter-arguments to activating it? Because it hasn't happened yet.
Precisely. Right now, UNI's primary utility is governance, which is invaluable, don't get me wrong, for decentralization and the protocol's long-term health. But it doesn't offer direct financial yield. Activating this fee-sharing mechanism would, I think, instantly and drastically increase demand for the UNI token by transforming it into that yield-bearing asset. Imagine owning a piece of a highly profitable, dominant exchange and directly benefiting from its success in the form of actual revenue flowing to your token. That fundamentally shifts the utility.
Yeah, you'd attract a whole different type of investor.
Absolutely. You'd attract a whole new class of investors, not just speculators hoping the price goes up, but value-oriented investors, maybe institutional funds, and anyone seeking intrinsic yield within DeFi. The economic mechanism is pretty simple. A token that accrues a value directly from the protocol's revenue is inherently more attractive and arguably more valuable than one that doesn't.
Makes sense. But what about those downsides? Why the hesitation?
Well, it's not without its counter-arguments, and this is where the robust community debate really lies. The primary concern is that taking any portion of fees away from liquidity providers, the LPs, could disincentivize them. LPs are the ones contributing capital, they take on the risk of impermanent loss, and they are absolutely crucial for the protocol's liquidity. If their yield gets reduced, some argue they might just move their capital to other DEXs that offer them 100% of the fees.
Right, potentially hurting Uniswap's core offering its liquidity.
Potentially, yeah. There's a delicate balance to strike. How do you reward token holders without cannibalizing the very liquidity that makes the exchange functional and attractive in the first place? This is why the community has deliberated for so long, and any implementation would likely need to be phased in or very carefully calibrated to avoid unintended negative consequences.
Yeah.
But the potential upside for UNI's tokenomics is just undeniable.
That tension between rewarding LPs and rewarding token holders is definitely a core dilemma across DeFi. But it's clear the market is hungry for tokens that offer direct value accrual. We've actually seen a powerful real-world analogy for this with the Leo LDO surge. Can you elaborate on that? Because it provides a really concrete example of this exact dynamic playing out.
Absolutely. The Lido LDO surge is a fantastic case study, really relevant here. Lido Finance is, as many know, a leading liquid staking protocol. Its token, LDO, similar to UNI, was initially primarily a governance token. However, as the whole staking ecosystem grew, especially with Ethereum's transition to proof of stake, the market began to factor in the immense revenue being generated by Lido services. When the community started seriously discussing and eventually implemented a mechanism for LDO to accrue value tied directly to Lido's protocol revenue, well, the market response was dramatic.
It really took off, didn't it?
It really did. LDO's price saw a significant repricing, a multi-fold increase over a relatively short period. Investors essentially re-rated the token. They stopped seeing it as just a governance play and started viewing it as having clear economic utility linked directly to the protocol's success. It proved demonstrably that this kind of token repricing can happen, and quite dramatically, when yield utility gets added to governance tokens. It provides a very clear, very recent example of that potential, and it's exactly why the UNI fee switch remains such a hotly anticipated catalyst.
That's a powerful parallel indeed. But, okay, beyond optimizing its internal economics with something like the fee switch, Uniswap is also strategically expanding its reach. Another major catalyst has to be its successful expansion onto various Layer 2 networks. We're talking about its presence now on Optimism, Arbitrum, Base, Polygon. The list keeps growing. What's the direct impact of this multi-chain, multi-L2 strategy? Why is it so crucial for sustained growth and user adoption?
The direct impact for users is immediate and profoundly positive. Just to clarify for listeners, Layer 2 solutions are essentially scaling technologies built on top of a main blockchain, like Ethereum. Think of them like high-speed express lanes built over a congested highway. They bundle up lots of transactions off-chain and then settle them efficiently back on the main chain. The key result: massively reduced gas fees and much higher transaction speeds.
Right, making things cheaper and faster.
Exactly. So for Uniswap, deploying on these Layer 2s like Optimism, Arbitrum, Base, Polygon, it massively reduces the cost, specifically those painful gas fees, for traders. In the past, high Ethereum mainnet gas fees could make smaller trades completely uneconomical, or just price out a huge segment of potential users from even participating actively in DeFi. By providing these cheaper, faster alternatives, Uniswap makes DeFi genuinely more accessible to a much broader global audience. We're talking retail traders with smaller amounts of capital, people in regions where even a $10 fee is prohibitive. It opens the doors.
And that accessibility, presumably, directly translates into higher trading activity and, crucially, a broader, more diverse user base, correct?
Absolutely. Lower costs remove friction. It's simple. It encourages more frequent trading, maybe smaller trades that weren't viable before. This attracts new participants who were previously just sitting on the sidelines because of the prohibitive fees on Ethereum mainnet. Consider someone wanting to swap, say, $100 worth of tokens. On Ethereum mainnet, that might cost them $20, $30, even $50 in gas at peak times. Completely unviable.
Yeah, wipes out any potential gain.
Right. On a Layer 2, that same $100 trade might cost just a few cents. So this expanded reach means more volume overall, more liquidity spread across all of Uniswap's deployments, and ultimately more value flowing through the entire Uniswap ecosystem. It's a fundamental scaling solution that underpins future growth. It allows the protocol to actually serve a global user base efficiently without being constantly bottlenecked by Ethereum's mainnet capacity and costs. It's truly a gateway to more mainstream adoption.
Okay, so beyond the individual retail user and the active day trader, There's another potentially massive wave that could hit DeFi, and that's the long-anticipated institutional adoption. We're observing this burgeoning trend of DeFi trying to integrate with traditional finance, or TradFi, as it's often called. How could this bridge between the old and new financial worlds specifically impact Uniswap and its valuation?
This is monumental, potentially game-changing if it plays out. The growing interest from traditional financial institutions, we're talking hedge funds, asset managers, even corporate treasuries, is arguably one of the most significant catalysts on the horizon. We're already seeing the emergence of new financial products, like the spot Bitcoin and now Ethereum exchange-traded funds, the ETFs. These act as highly regulated, familiar, and accessible conduits for institutional capital to flow into the space.
Right, the ETFs are like an easy on-ramp for them.
Exactly. And these institutions, they're looking for compliant, secure, and highly liquid ways to gain exposure not just to crypto assets like Bitcoin or Ether, but increasingly to the underlying infrastructure of DeFi itself. Uniswap, being the dominant and most liquid DEX, is just perfectly positioned to capture a large share of this incoming institutional capital, assuming the regulatory pieces fall into place.
How would that work, though? Would big institutions just start aping into random pools? Seems unlikely.
Probably not directly into the main permissionless pools, at least not initially. Instead, we could see the development of things like permission pools, maybe with built-in KYC checks, or specialized interfaces designed for institutional clients, or even entirely new liquidity solutions built on top of Uniswap's core infrastructure, but tailored for institutional needs and compliance requirements. These adaptations would allow institutions to maintain their regulatory compliance while still leveraging the efficiency, the transparency, and the deep liquidity of decentralized infrastructure like Uniswap. This potential influx of institutional funds, we're talking potentially tens or even hundreds of billions of dollars over time, could push trading volume to unprecedented record highs across all of DeFi. Given its established market leadership and brand recognition, Uniswap would undoubtedly be a primary beneficiary. It could see an explosion in liquidity and trading activity that would dwarf anything we've seen before. It's really the ultimate validation for the entire decentralized finance thesis.
And speaking of broader market movements, we absolutely cannot ignore the powerful force of market cycles. A general DeFi resurgence, riding the wave of a new, sustained bull market, could truly be the rising tide that lifts all boats, Uniswap included. We've seen this dynamic play out dramatically before, haven't we?
We certainly have. Crypto markets are inherently cyclical. They're often characterized by these intense boom and bust periods. After prolonged periods of consolidation or bear markets, investor sentiment inevitably shifts, sometimes quite rapidly, leading to a new bull run. In that kind of environment, investor appetite for riskier, high-growth assets increases exponentially. People start looking for opportunities to maximize their returns, and that often means they chase yield or seek out assets with strong growth narratives and clear fundamental utility. Robust DeFi protocols with proven track records, deep liquidity, strong communities like Uniswap become highly attractive targets for this incoming capital. They represent established infrastructure within a burgeoning sector.
Yeah, people rotate into DeFi when things get hot again.
Exactly. We only need to look back at the DeFi summer of 2020. That period was just a Cambrian explosion for decentralized finance. It was a time of frenzied innovation, experimentation, exponential growth, new protocols popping up daily, capturing billions in value in what felt like weeks. What's particularly relevant for Uniswap here is that the initial UNI token distribution itself, which happened in September 2020, effectively kickstarted the whole concept of a fair launch for governance tokens. It set a powerful precedent for explosive growth during periods of renewed investor interest and capital influx.
The retroactive airdrop was legendary.
It really was. So a similar market environment may be fueled by new institutional money we just talked about, renewed retail enthusiasm, maybe some good old-fashioned FOMO, fear of missing out, would likely see a massive reinvestment into established DeFi blue chips. Uniswap, as the undisputed leader, would be poised to capture a lion's share of that capital, potentially leading the charge in a new wave of DeFi adoption and valuation.
Okay, finally, before we move to the hurdles, let's briefly touch upon the ongoing evolution of Uniswap's tokenomics and governance model itself. While the fee switch is obviously a huge part of this conversation, there's also the broader potential for more utility for the UNI token beyond just voting rights. What are the ongoing community discussions and potential avenues for enhancing UNI's value proposition in the future, even if they don't immediately flip that fee switch?
That's a crucial point, and it signals a healthy ongoing conversation within the Uniswap community about maximizing UNI's long-term value. While the fee switch remains the most direct, maybe the most obvious route to direct value accrual, there's always an active exploration of other innovative ways to enhance the token's utility. For instance, discussions often revolve around potential staking mechanisms for UNI. Holders could maybe commit their tokens to help secure the protocol or participate in certain specific processes and earn rewards for doing so, rewards separate from direct fee capture. We've also seen proposals exploring things like using UNI as collateral in other DeFi protocols, using the Treasury UNI to fund community grants and development initiatives, or even potentially having UNI serve as a base asset for new financial primitives being imagined and built within the Uniswap ecosystem itself.
So the innovation isn't just in the trading protocol, but also in what the token does.
Exactly. The beauty of decentralized governance, when it works well, is that the community is empowered to continuously adapt and innovate. This ongoing evolution, driven by active governance participants and a clear desire to strengthen the token's economic ties to the protocol's success, suggests that the community is deeply committed to finding ways to further cement UNI's value proposition. It means that even if the fee switch isn't activated tomorrow, there's a strong likelihood that other innovative utility mechanisms could emerge over time, contributing to its long-term viability and its potential for a significant re-rating by the market. All right, we've thoroughly explored the incredible potential and the powerful catalyst that could drive Uniswap towards that ambitious $70 valuation. But as we know all too well in the volatile world of crypto, no journey is without its significant obstacles and complexities. We need to be realistic about the formidable hurdles that stand in its way. So what's the biggest elephant in the room that Uniswap and frankly the entire DeFi sector has to contend with right now? The biggest elephant in the room, without a shadow of a doubt, is regulatory pressure. Yeah. The specter of increased scrutiny from regulatory bodies, particularly the SEC's intensifying focus on DeFi governance, decentralized exchanges themselves, and the classification of various tokens. It casts a significant shadow over everything. The fundamental decentralized nature of these protocols often clashes directly with traditional financial regulations, which were, designed for centralized entities with clear addresses, clear boards of directors, clear lines of accountability.
Right, DeFi doesn't fit the mold.
Not at all. This creates immense legal and operational uncertainty for projects like Uniswap. Consider the current regulatory climate, especially in the United States. The SEC has taken quite aggressive enforcement actions against centralized crypto entities, and they've clearly indicated a keen interest in DeFi, particularly in governance structures and the potential classification of certain tokens as unregistered securities.
Which could include governance tokens like UNI.
Potentially. That's the uncertainty. This ambiguity can create significant headwinds for innovation and adoption. Projects become more cautious, legal costs can soar, and institutional investors who are generally very risk-averse by nature might shy away simply due to the lack of clear guidelines. It directly impacts investor confidence, it can limit the scope for developing new products, and it creates operational instability for decentralized projects trying to function globally. The critical question here becomes, how will DeFi protocols like Uniswap adapt to, or maybe even influence or help shape clearer regulatory frameworks without compromising their core tenets of decentralization? That balancing act is a monumental challenge.
Yeah, finding that balance seems incredibly difficult, and the outcome will profoundly impact Uniswap's trajectory, right? There's this constant tension between wanting regulatory clarity so the big money can come in, but also preserving that permissionless innovation that makes DeFi special.
Exactly, it's a core tension.
Okay, so regulatory clarity, or the lack thereof, is a constant looming challenge. But even setting that aside, within the DeFi space itself, Uniswap isn't operating in a vacuum. It exists in a highly competitive arena. So who are its most formidable rivals, and how does that intense competition impact its path to $70? It must necessitate continuous innovation just to stay ahead.
Oh, absolutely. While Uniswap undeniably holds the top spot by most metrics, it's a crowded and incredibly dynamic field. Innovation happens at lightning speed in DeFi. We're talking about formidable competitors, each with their own strengths and specific niches. Take Curve Finance, for instance. Curve specializes in very specific ultra-low slippage swaps for stablecoins and other similarly pegged assets like different versions of wrapped Bitcoin or staked Ether. They dominate that particular market segment with their unique AMM design.
Right, Curve is king for staples.
Definitely. Then there's SushiSwap. Sushi started as a direct fork of Uniswap, famously, but has since built out its own extensive ecosystem. They have lending, staking, a launchpad. They've established a very strong community-driven brand identity. PancakeSwap is another behemoth, particularly dominant on the BNB chain, formerly Binance Smart Chain. It caters to a massive user base there, often leveraging lower transaction fees and a more uh, gamified user experience.
Yeah.
And then you have platforms like DYDX, which offers a more traditional, centralized style order book experience, but running on a decentralized network. They focus primarily on perpetual futures trading, appealing to more sophisticated derivatives traders.
So a lot of different angles of attack from competitors.
Exactly. This constant innovation race means that while Uniswap has its undeniable first-mover advantage and strong brand recognition, these competitors are constantly pushing the boundaries. They're offering different models, specialized services, and they're often vying very aggressively for market share and liquidity, often using various incentive programs, yield farming rewards, etc. The pressure on Uniswap to continuously evolve its product, enhance its features, improve its capital efficiency like they did moving from V2 to V3, and maintain its technological edge is just relentless. It cannot simply rest on its laurels. It has to continually out-innovate and adapt to stay ahead, making sure its platform remains the preferred destination for the vast majority of decentralized trading volume. Any period of stagnation could potentially open the door for a competitor to gain significant ground.
Makes sense. And finally, let's circle back to a hurdle that comes from Uniswap's own design. The ongoing criticism of UNI's current governance-only model. We touched on it earlier when discussing the fee switch catalyst, but why is this still widely perceived as a significant intrinsic dilemma for the token? Why might it be holding back its valuation compared to other tokens?
Yeah, it's a persistent point of discussion. The core issue, as it stands today, is that the UNI token, in its current form, lacks that direct fee capture mechanism. It doesn't give holders a direct share in the protocol's revenue. Now, it grants incredibly powerful governance rights, allowing holders to vote on crucial protocol upgrades, how the treasury funds are managed, potential fee structure changes like activating the switch itself, but it doesn't directly entitle them to a slice of the protocol's cash flow today. This is a fundamental difference when you compare it to many other tokens of the DeFi space. For example, tokens like GMX from the GMX derivatives protocol, or even MKR from MakerDO, which we mentioned earlier, actively collect fees or accrue value directly for their holders based on protocol performance.
So, if you're an investor just looking for yield,
Exactly. If you're an investor primarily focused on immediate financial returns and generating yields from your holdings, you might perceive UNI as less attractive from a purely financial perspective compared to tokens that offer that immediate tangible yield or value accrual. What's truly fascinating here, I think, is how the market continually debates the value of pure governance versus direct financial utility in these decentralized networks. For some purists, robust decentralized governance is the ultimate utility. It ensures the protocol remains adaptable, censorship-resistant, truly community-owned in the long run. For others, though, particularly those coming from a more traditional investment mindset, the absence of direct fee capture is seen as a significant drag on demand, a missing piece of the puzzle. So this ongoing internal debate about its intrinsic value, while arguably a sign of a healthy and engaged community wrestling with big questions, means that a large portion of the market might still be waiting for that direct financial incentive, like the fee switch, before fully committing to UNI's long-term value proposition and pushing its price towards what they perceive as its fair value. It's a hurdle of perception and economic incentive that will likely persist until its utility further evolves in some way.
okay, so let's imagine Uniswap successfully navigates those tricky hurdles we just discussed and those powerful catalysts align perfectly. What does reaching $70 truly mean? It's got to be far more than just a number flashing on a trading chart, right? You mentioned earlier it would be about unequivocally cementing UNI as the blue chip of DeFi. Could you elaborate a bit more on what that blue chip status truly signifies in the crypto context? Why is it such a coveted position?
You've hit on a critical point there. In traditional finance, a blue chip stock refers to a really well-established financially sound company. Think long track record of reliable earnings, strong balance sheet, stellar reputation. Companies like Coca-Cola or Apple often come to mind. In crypto, blue chip status translates to similar qualities, adapted for this space. It signifies reliability, first and foremost. Fundamental value derived from actual real-world utility in Uniswap's case, facilitating billions in trades. A proven track record of security and uptime, which is crucial in DeFi. Consistent innovation, adapting to the market, a robust and genuinely engaged community supporting it, and sustained relevance within its niche, which for Uniswap is obviously decentralized exchange. It basically means a project is not just some speculative bet, but a foundational, enduring pillar of the entire ecosystem, something capable of weathering market storms and continuously delivering value over the long term.
So it's about trust, stability, and real utility.
Exactly. Therefore, reaching $70 would unequivocally cement UNI's status as the undeniable blue chip of decentralized finance. It would place it firmly on par with, or potentially even above, other established ecosystem tokens like Solana and Avalanche in terms of market capitalization, overall influence, and investor confidence. At that $42 billion to $50 billion market cap range we talked about, it would be playing in the same league as many well-known publicly traded tech companies, not just other cryptos. This isn't just about Uniswap's price, it's a profound statement about its resilience, its indispensable role in the entire DeFi landscape, and its perceived long-term viability in this rapidly evolving digital asset space. It signals to the wider world, I think, that decentralized applications can achieve the same, if not potentially greater, levels of trust, volume, and economic impact as their traditional centralized counterparts.
That's a powerful point. And it leads us directly to the idea of DTEX as not just occasionally rivaling, but consistently and structurally challenging centralized exchanges, maybe leading to a genuine paradigm shift in how we conduct financial transactions globally. A $70 UNI would fundamentally validate the entire model of decentralized exchanges as potentially a superior alternative, wouldn't it?
It absolutely would. A Uniswap with a $70 UNI token and the implied market cap and trading volume that comes with it would prove beyond any reasonable doubt that DZXs can not only rival but potentially surpass centralized exchanges in both revenue generation and overall market dominance. This isn't just about those fleeting moments of higher volume during peak volatility or specific market events. It's about establishing a persistent, undeniable competitive advantage rooted in the core tenets of decentralization. That transparency, the censorship resistance, the direct user control over their own assets. It would signify a powerful and frankly maybe irreversible shift in the financial landscape, where users increasingly opt for the advantages offered by decentralized platforms over traditional intermediaries.
So those days where Uniswap beats Coinbase volume wouldn't be anomalies anymore.
Exactly. Think back to our earlier comparison. Those moments when Uniswap outperforms Coinbase in daily volume. A $70 UNI would elevate those individual data points from just interesting anomalies to a consistent trend, maybe a regular occurrence, perhaps even the new normal in certain market conditions. It would underscore that the shift isn't just possible, but maybe inevitable under the right conditions, driven by a global user base seeking greater financial sovereignty and efficiency. So what does this all mean for the broader market? It means the future of exchange could truly be decentralized, with Uniswap not just participating, but confidently leading the charge. This level of valuation would be a massive, undeniable signal to the world that decentralized finance isn't just some experimental niche anymore. It's a robust, scalable, and ultimately a potentially superior alternative for global financial exchange. It's a real statement about where finance is heading.
Okay, to make this even more concrete for you listening, let's ground ourselves in some real-world examples and crucial data points that powerfully reinforce this entire narrative we've been building. These aren't just hypotheticals. These are historical instances where similar forces have played out, demonstrating precisely how value can be unlocked and how growth can accelerate in this space. First up, let's revisit the fascinating story of MakerDAO's revenue model transformation. How did they change things?
Yeah, MakerDAO, the pioneering decentralized autonomous organization behind the DAI stablecoin, underwent a really significant and highly impactful transformation. For years, its native token, MKR, primarily derived its value from, well, governance rights and the perceived stability and importance of the DAI ecosystem. However, MakerDAO made a pretty bold strategic pivot by integrating real-world assets, or RWAs, into its treasury and its revenue model. This involved using a portion of its massive treasury, funded by stability fees, to generate yield from traditional low-risk financial instruments, primarily U.S. Treasury bills.
So using DeFi reserves to earn yield from TradFi assets. Exactly. By adding this tangible real-world asset yield to its revenue streams, MakerDAO profoundly transformed the narrative around its native MKR token. It demonstrated that even well-established governance tokens can unlock significant new value and attract new capital when innovative, sustainable revenue models are integrated. It proved that a token's utility, even if initially just governance-focused, can expand to include direct financial benefits derived from the real economy. And this led to a major reevaluation of MKR's intrinsic worth by the market. It wasn't just a technical tweak. It was a philosophical shift that resonated deeply with investors looking for more than just speculative upside, maybe some more stable yield.
And we also saw that remarkably similar, perhaps even more direct, parallel with the Lido LDO surge, which we highlighted earlier as a key potential catalyst model for Uniswap. Could you just quickly reinforce how Lido's dramatic price movement really proved this concept of token repricing when yield utility is added? Absolutely. The Lido LDO Surge is just one of the clearest examples we have. Lido is dominant in liquid staking, especially for Ethereum. Its LDO token, initially, like UNI, a pure governance token, saw this dramatic price surge through late 2022 and into early 2023. What really catalyzed this was the market's growing realization, and then the subsequent confirmation through governance, that LDO would accrue value directly from Lido's substantial staking revenue stream. Once it became clear that LDO token holders would effectively gain exposure to a portion of the vast income generated by Lido's liquid staking services, the market responded with an explosive repricing. We saw LDO's value increase by several 100% in a relatively short time frame. This direct connection between holding the token and receiving yield is the exact mechanism that could drive UNI towards $70 if the fee switch is activated. LDO provides a very clear, very recent, and highly successful example of that potential playing out in real time. It moved from being just a governance token to an investment that actually pays you for holding it.
Yeah, the market clearly values that direct link, and we can't talk about foundational moments without vividly revisiting the broader historical precedent of DeFi summer 2020. I remember the frenzy back then, the new protocols popping up daily, the insane yields, the excitement in every corner of the crypto world. How did this pivotal moment, and specifically the UNI distribution, lay the groundwork for the entire sector's explosive growth and maybe set the stage for what we're discussing today?
DeFi summer 2020 was genuinely a watershed moment. Yeah, a period of intense experimentation and just explosive growth for the entire crypto space. It was the time when the potential of decentralized finance truly became undeniable for many people. Hundreds of new protocols emerged, offering everything from lending and borrowing to complex yield farming strategies, attracting billions in capital in what felt like just a matter of months. What's particularly significant for our deep dive into Uniswap is that the initial UNI token distribution in September 2020 wasn't just another token launch. It effectively kickstarted the entire concept of a fair launch and the widespread adoption of governance tokens as we know them. Uniswap retroactively distributed UNI tokens to every single wallet address that had ever interacted with its protocol up to that point. That created an instant, incredibly broad base of token holders who then had a vested interest and a direct say in the protocol's future direction. That move really created a blueprint for how decentralized communities could form, how they could govern powerful protocols, and how they could rapidly bootstrap a network effect. It laid the groundwork for the entire sector's explosive growth and set the precedent for community-owned infrastructure. So these historical events and case studies, Maker, Lido, DeFi Summer, they are just interesting stories. They are empirical evidence for the specific economic and social mechanisms that could potentially propel UNI forward once again under the right conditions.
Okay, now for those of you listening who are really data-driven and love to track the metrics, let's look at some specific charts, key metrics, and analysis ideas that can help us monitor UNI's potential path towards that $70 target. This isn't purely about speculation, it's about observing the tangible, often on-chain data that will signal whether Uniswap is truly on this exciting, ambitious trajectory.
Absolutely. First, there's the UNI price projection path itself. We're looking at a hypothetical trajectory, right? From the current $7 ATOL range, maybe making an intermediate stop somewhere around $20 as it builds momentum, then reclaiming its previous all-time high, around $44, and ultimately pushing through that significant psychological barrier towards $70. This journey would involve continuously comparing its market cap against those blue-chip peers we mentioned, like Solana and Avalanche, to track its relative growth and standing within that top tier of crypto projects. Each milestone, breaking $20, reclaiming the AT, pushing towards $70, would likely mark a significant re-rating of its value proposition by the market, hopefully driven by concrete developments like the fee switch or massive volume growth and growing investor confidence. Understanding the psychology of breaking previous highs and entering price discovery is crucial. It often ignites fresh waves of interest and capital.
Right, watching those key levels and the market cap comparisons. What else?
Another absolutely crucial metric to watch closely is the DX volume versus centralized exchange, CEX volume. Specifically, we want to highlight and track those moments when Uniswap is consistently surpassing a major player like Coinbase in daily trading activity. This isn't just a fleeting statistic for a single day, it's a profound key indicator of the growing influence and adoption of decentralized exchanges over their centralized counterparts. Tracking this data regularly, maybe on platforms like DeFi or CoinGecko, will provide real-time insights into Uniswap's ability to capture a larger share of the global trading volume pie. Consistent outperformance would be a massive bullish signal, indicating a fundamental shift in user preference towards decentralized permissionless trading is underway.
And we absolutely need to pay close attention to total value locked, or TVL, trends as well. Just remind listeners quickly what TVL tells us.
Sure. TVL represents the total dollar value of all the assets currently locked or staked within a specific DeFi protocol. It serves as a key indicator of its overall liquidity depth and the capital commitment from its users, primarily liquidity providers. So tracking UNI's liquidity growth, its TVL, against its formidable competitors, Curve, SushiSwap, PancakeSwap, maybe even newer DXs, will provide invaluable insights into user trust, the depth of its liquidity pools, which affects slippage on large trades, and the overall health of the platform. A consistently growing TVL relative to competitors, especially if that growth isn't solely driven by temporary unsustainable liquidity mining incentives, indicates increasing confidence from both LPs and traders. That's vital for an exchange's ability to handle large trades efficiently.
Okay, TVL is key for liquidity health. What about the token itself?
Beyond just liquidity, looking at the UNI holder distribution gives us a critical window into the decentralization and the broad adoption of the network itself. Observing on-chain wallet growth meaning is the number of unique addresses holding UNI increasing over time. And looking at the concentration of UNI tokens can tell us the story. Is ownership becoming more distributed among a wider user base? Or is it becoming more concentrated in the hands of few large holders, sometimes called whales? While some concentration is pretty natural, especially for early projects or protocols with large treasuries, a clear trend towards broader distribution over time is generally seen as a healthy sign of decentralization and long-term network health. It attracts more diverse participation and arguably reduces the risk associated with single points of failure or control.
Makes sense. Decentralization matters. And lastly,
Finally, governance voting participation is an often overlooked but utterly critical metric for a truly decentralized protocol like Uniswap. The evolution of UNI community decisions, including the volume and the nature of the proposals being submitted, the quality and depth of the debate surrounding them in forums, and crucially, the actual voting turnout reflects the health and engagement level of its decentralized governance model. Active, informed participation demonstrates a robust community that can effectively steer the protocol, adapt to new challenges, and implement crucial changes, like, for instance, the fee switch we keep coming back to. High participation rates, rigorous debate, and efficient, transparent decision-making processes are all strong signals of long-term viability and ultimately contribute significantly to its value proposition. It shows that the community isn't just passively holding tokens, but actively building and shaping the future of the protocol. Hashtag to hashtag outro.
okay, that was a deep dive indeed. This raises, I think, an important question for all of us listening to ponder. After diving deep into Uniswap's incredible potential and also its inherent pitfalls, do you personally believe UNI is truly the most undervalued blue chip in DeFi right now, really poised for a monumental breakout? Or conversely, do you see the road to $70 still paved with just too much regulatory risk, too much intense competition, and maybe too much intrinsic uncertainty for decentralized exchanges to truly and consistently overtake their centralized giants? It's a question that gets to the very heart of where you envision the future of finance heading.
It's the multi-billion-dollar question, isn't it?
No, it really is. If this deep dive gave you a clearer picture of Uniswap's exciting and, let's face it, complex path potentially towards $70 and maybe helped you connect some of those dots, make sure you hit that like button, subscribe to the channel if you haven't already, and definitely turn on the notification bell. Your engagement, every like, every comment you leave below, every share, and every new subscription, it really does help us grow this channel. It boosts our visibility in the algorithm so more people like you can find these in-depth insights. And it allows us to keep bringing you these deep dives into the most fascinating corners of the crypto world every single week. Your support is genuinely what makes all of this possible, and we truly appreciate you tuning in.